Good morning, distinguished ladies and gentlemen. I have the singular privilege and honor to welcome all of you who are in the auditorium here at the Central, I wanted to say Central Bank. If you are CIBN, this is another central bank, because this is where this is the home to all bankers in Nigeria for decades. It's called the Bankers House. And the Bankers House represents, of course, the entirety of Nigeria's banking institution. My name is Boason Omofaye, and I have the pleasure of welcoming not just in the audience, but also who are online at Proshare.co and others who are also joining us to watch this particular launch by Proshare LLC. Proshare needs little introduction, but of course I'll go ahead to introduce this great organization that has distinguished itself in the field of financial news, information, research, and publishing over the last close to 2 decades. I'm proud to be associated with this organization that is making giant strides in ensuring that Nigeria has the relevant information investors, both local and abroad, have what it takes to make investment decisions, not just in the financial markets, the banking sector, but the entire Nigerian economy. Please give a round of applause to members of the Proshare team. Thank you very much, ladies and gentlemen. We're spending about an hour or two together to discuss and chew over the 4th edition of the Proshare Tier 1 Banks report, Getting Bigger, Braver, and Dominant, the class of 2025. It feels like being back in school all over again. Welcome to the class of 2025. Thank you, everyone. Let me say a very big thank you to the founder and the chairman of Proshare LLC, Mr. Femi Awoyemi, for leading the team. Good morning. Welcome. Thank you for leading a great team over the years, for providing important reports, as always, as necessary for the Nigerian market, whether for the capital market, for the banking sector, and the entire financial system and the economy. Very engaging report, and we're happy to share another one that your team has put together for us this morning. Let me say very thank you also to our chief host, and please put your hands together for the president and the chairman of council of the Chartered Institute of Bankers of Nigeria, Professor Pius Olanrewaju. Let's put your hands together for him. And he is here today ably represented by Mr. Akin Morakinyo, the registrar of the CIBN. Mr. Morakinyo, thank you very much for representing Mr. President at this event. We appreciate your generosity of giving us your hall, the main hall of the CIBN, to host this Proshare event. Thank you very much. We understand Professor Pius Olanrewaju was unavoidably absent. He's hosting other presidents of the Institute for a major meeting. Thank you very much for your generosity. Please let me say a very big thank you to one of our panelists who's here present. Please put your hands together for the chairman of the Banking Commission, ICC Nigeria, Dame Dr. Omolara Akanji, a former director of the Central Bank of Nigeria. Mrs. Akanji, thank you very much. We hope to tap from your wealth of experience in central banking and the banking sector in general this morning. Thank you so much, madam, for making the time. Let me also say a big thank you to other panelists who will be coming. We're expecting them in the auditorium momentarily. Dr. Biodun Adedipe, of course, is a renowned Nigerian economist, the CEO and chief consultant at Adedipe. Let's give you a round of applause. And also coming up on the program is Dr. Ayodeji, Ebo, who is the managing director and chief business officer at Optimus by Afrinvest. A round of applause for Dr. Ayodeji Ebo. He's also a chartered stockbroker and a licensed market professional as well. He's also joining. We're expecting him to be with us here as well for some of the presentations and to discuss the latest report. And just to tee off some of the presentations, of course, this report will be delved into by members of the Proshare team. Of course, we'll hear from Femi Awoyemi, who is the chairman and founder of Proshare LLC. Then, of course, we'll hear from Dr. Teslim, let's put in a round of applause. Teslim Shitabe, Director and Managing Editor, Tier 1 Report. Please stand up for recognition. We appreciate you coming here and the rest of your team. Let me also recognize the Head of Research at Proshare, Mr. Tosi Ige. Where are you? Okay, thank you. Good to have you also in the house. And of course, you have other top officials of Proshare LLC as well in the audience. Thank you so much, everyone. Now, let me invite Mr. Aki Murakio as our landlord to please give us a few words of goodwill from the President of the Chartered Institute of Bankers of Nigeria. Round of applause as he comes to the podium. Mr. Murakio, please. The registrar.
Thank you very much, Mr. Boason. One more time, please let me appreciate our MC, Mr. Boason Omofaye. The founder of Proshare, our own revered fellow of the Chinese Bankers of Nigeria, Mr. Olufemi Awuyemi, FCIB, very distinguished and eminent personalities here gathered, both physically in the Bankers House and those joining us on the virtual platform, our esteemed panel of discussants, distinguished ladies and gentlemen. Please permit me to rest on the well-established protocol which has been highlighted this morning, and to bring you goodwill message from the President and Chairman of Council of the Chinese Bankers of Nigeria, Professor Pius Deji Olarewaju, who is unavoidably absent for good cause, but he has his speech, which I will read to you shortly. And so it's an honor to be part of this engagement this beautiful morning. I'll now take the comments, remarks of the President and Chairman of Council. I am delighted to join you today for the launch of Nigeria's Tier 1 Banks Report 2025, published by Proshare. The report themed Getting Bigger, Braver and Dominant, the class of 2025, is particularly timely. I extend warm greetings and heartfelt congratulations to our own esteemed fellow, Mr. Olufemi Awuyemi, FCIB, founder and chairman of Proshare. Please, you can clap. And the entire team for this timely and strategic intervention. We are gathered here today at a critical juncture in the evolution of Nigeria's financial services sector, one that demands critical thinking, bold and audacious actions, sound governance and vigilance, strategic alliances, and most importantly, resilient capital structures. The ongoing bank recapitalization initiative unveiled by the Governor of the Central Bank of Nigeria during the 2023 CIBN Annual Bankers Dinner is not merely a regulatory directive, but an imperative action for the Nigerian banking industry to redefine its future, strengthen its balance sheet, and enhance its impact and global competitiveness. As the umbrella professional body for banking and finance in Nigeria, the CIBN is committed to fostering an ecosystem that upholds ethics, professionalism, innovation, and capacity building. This endeavor that we are witnessing today aligns with my legacy agenda, particularly in leading an innovative financial system and accelerating the Institute's vision of a stronger more inclusive, and globally respected banking industry. The theme of today's event rightly captures the spirit of transformation that is required. Getting bigger through strategic growth and consolidation, getting braver by embracing bold reforms and innovation, and becoming dominant through operational efficiency, strong governance, and regional expansion. The insights from this report and the robust panel discussion that we will witness will serve as valuable inputs for banks, regulators, policymakers, and investors as we collectively navigate the evolving dynamics of the capital adequacy, risk management, digital disruptions, and global interconnectedness. In the words of Jim Collins, the author of Good to Great, greatness is not a function of circumstance. Greatness is largely a matter of conscious choice and discipline. Today's gathering, and indeed this report, invites us all to make that conscious choice to elevate Nigerian banking industry from stability to true global significance. Distinguished audience, let me use this opportunity to commend Proshare for your consistent thought leadership and evidence-based reporting, which continues to enrich discourse and deepen stakeholders' engagement within our financial ecosystem. I thought Proshare deserves a warm round of applause. Once again, congratulations on the successful launch of this pivotal publication. May it spark the courage, clarity, and collaboration that our industry requires to thrive in the years ahead. Thank you, and God bless. Professor Pius Deji Olarewaju, the 23rd President and Chairman of Council of CIBN. I wish you all a happy deliberation. Thank you very much.
Thank you. Please, a more round of applause for the President of the CIBN, represented by Mr. Aki Murakiyo. Thank you so much to the Registrar. You set the tone for this event by that very powerful goodwill message. That was more than goodwill. That's a major presentation that goes into the heart of today's event. Thank you so much, the unveiling of this report. And I'm sure I haven't seen what Olufemi Awoyemi's speech or opening remarks will look like. But I'm sure that as this report's getting together on recapitalization of the banking industry, he will be casting his mind back to the first recapitalization and the intervention of 2010. The nights we spent together working on some of these reports. Isn't it very interesting? Hold on a second, Femi. Because, you know, it's the second recapitalization in 2 decades. Yes, 2004, 2005, and now 2024, 2025 into March 2026. So this is round 2 in a manner of speaking. So what are the lessons? Now you're thinking. But it's very good. You're in good company. But let's hear from the founder and the chairman of Proshare LLC. Put your hands together for Olufemi Awoyemi, FCIB.
Good morning. Good morning. In 2021, when Proshare produced its first Tier 1 banking report, what had happened was that there was a simple question we needed to resolve. What is a Tier 1 bank? The answer was complex, to say the least, and it led to a review of the research originally done by Afrinvest Research. They had coined the term FUGAS, which meant First Bank, UBA, GT Bank, Access Bank, and Zenith Bank. Indeed, during the inquiry we embarked upon, another set of questions emerged. Are Tier 1 banks a fixed set of lending institutions or a fixed number of players? These were the things that concerned us, and when we interrogated that report, we aimed to answer. By the time we finished, First Bank had dropped out and Fidelity Bank had stepped in. Even though we were in the FUGAS, but a change in composition set the tone for what will happen. Assessments have shown shifts in banks or their rankings within the Tier 1 category. This has happened for two reasons. The first is that Proshare researchers expanded the criteria for Tier 1 banks qualification by introducing new variables and a revised methodology, something which we would expand upon during the presentations. The second is that the research team decided that rather than a 10-year review of methodology, the revision of the methodology will occur every 5 decades. Why? Because the shelf life of activities and developments in Nigeria was now much more accelerated. A few key findings which the Director of Research and MD would elaborate upon are that: one, we are back to what we call the Fugazi Tier 1 banks again. This time, asset size is important, but not definitive in deciding a Tier 1 bank. Capital size is important for Tier 1 banks, and with the recapitalization exercise we started last year and would end in March 2026, the race to the top will be very intense. Banking as a tool to support growth will be reshaped as it prepares for economic transition, and transformation. This report, therefore, expresses our concerns about institutional comparisons as banks migrate to holding company structures with regulatory ambiguities. In the new age, the Tier 1 bank report would indicate that Nigerian banks are entering a new era. Their relationship with neobanks will become more complex, involving different shades of collaboration and competition, which will ultimately be resolved in favor of conventional banks. As investors in fintechs begin to call for returns on their investment, and regulators also impose stricter operating guidelines. So the age of brick and mortar financial lending institutions will slowly give way to cyber solutions resting on the back of blockchain, DLT, and artificial intelligence. But the biggest banking battles to come will be for market share and the locking in of customers and their transactions journey. So the current report highlights the consequences of this development and signposts the growth of open banking and AI applications and the strengthening of financial lenders' realignment with customers' needs. Three things are definitely certain, therefore. Capitalizations will lead to bigger banks in search of greater efficiency and profitability. Technology will play a larger role in driving financial intermediation. This will see consolidation in the industry and lead to major takeovers of fintechs and neobanks. The issue is not necessarily how, but when. More Nigerian banks will optimize their balance sheet by venturing into markets beyond Nigeria as they expand their customer bases and diversify their market risk. This report would not be complete if we do not provide contextual realities, i.e., to talk about geoeconomic and geopolitical realities of the world, which have undergone significant changes with corresponding economic implications. Foreign actions, such as the United States trade unilateralism that was forced into bilateralism by global market forces, and domestic policies, the subsidy removal on FX, retail prices on petrol, and fiscal reforms ongoing, have seen the Nigerian economy rise. It is clear to everyone that the macroeconomic indicators are significantly improved, yet, in contrast, household economies and welfare have fallen. While the foreign exchange market has remained stable and domestic inflation has been moderately declining, the average Nigerian household has experienced economic difficulties, higher food prices, utility costs, and higher rents. Indeed, there is an aberration. In some houses, electricity cost is higher than the rent people pay. That said, sustainable infrastructural development has been difficult to achieve. For example, a recent report on the impact of flooding in Nigeria showed how a rail track in Mokwa, Niger State, was completely washed away, with the rail line dangling precariously between two opposite sides of washed-away land. While it has a dramatic effect, it represents both a threat and opportunity for Tier 1 banks to engage on financial arrangements with development banks, investment vehicles, and private firms. To do two things. One, we have to begin to support self-financing and self-sustaining infrastructural projects, such as rail lines, roads, and bridges. Second, we must introduce collateralized mortgage obligations that enable businesses to leverage assets to generate cash flows that support business growth. These mortgage obligations could be packaged into medium-term tradable capital market instruments. In other words, Tier 1 banks must be noted for their economic contributions as much as their balance sheet. Late last year and early this year, the research team at Proshare sat down and put together a review of GDP and under the economy with which banks operate. We were happy to conclude that we could break down the Nigerian economy into 14 economies. The 14 sub-economies will determine how the GDP flow will be. Can you move the slide? No. Can you go back to the slide? Yeah. So during the launch of the Nigerian Capital Market Report, which we released on January 15, 2025, I had observed that Nigeria was at almost setting up itself for a perfect storm. But we now have a pathway for the country. And despite the gloom, we appear primed to confront the hard choices needed to deliver the change we seek. And for those who desire growth, pursuing purpose over popularity must be the basis of the engagement. I stand with the prognosis then, and indeed, I will point out that it is clear that the time has come for those of us in the private sector to seek a new way to engage, a mind shift where our truths must be delivered through a solution-based mindset. It is cheap and easy to criticize. Now is the time for a mental shift, which has set the tone for Proshare's continued interrogation of data to gather and process the correct numbers and narratives, providing an appropriate analytical interpretation of business facts distinct from fiction. The figures we have presented in our Tier 1 banks, the class of 2025 report, reaffirm the resilience and innovativeness of Nigeria's banking system. For the country to grow between 7% and 8%, and some people actually believe we need a 15% growth depending on the GDP-based figure you rely on, and despite the doom which the World Bank report yesterday on banking growth says, we believe that what Nigeria requires is what we call a GSM moment, a market-creating burst of economic activity. We saw this happen with the GSM technological revolution, which started between 2000 and 2001, which has delivered growth both in the lifestyle economy, in the creative industry, and just totally transformed the nation. It will not happen with hype. It will not happen with propaganda. It would have to happen with actual activities. The American journalist Sidney J. Harris once noted, man's dilemma is that we hate change and love it at the same time. What we really want is for things to remain the same but get better. Unfortunately, staying the same and getting better rarely happen. In closing, therefore, I would like to summarize the reasons for how we determined the bigger, braver, and dominant banking sector. The Nigerian banks have raised 13 trillion in new share capital. The implication is that the recapitalized banks have significantly higher capital adequacy ratios, have lower cost of risk, have a larger asset size, have higher capital buffers against non-performing loans, and have a relatively modest cost-to-income ratio. If you take a look at the screen in front of you, you will notice that those banks which we had before have increased capital. But for some significant factor, the total capital raise still falls lower than where we started from, which means that there's still a lot more work ahead to even begin to compete with our nearest factor. So if you look from the base where you are and comparing yourself there, and you do all that hard work and move in there, and you're still there, you can then imagine and the justification for why this recapitalization is so important and why those numbers will continue to grow larger. A larger capital, therefore, means that substantial operating buffers against loans defaults and greater incentives to fund projects will occur. Ultimately, I anticipate that you don't have to take my word for it, but that the contributions of the esteemed panel of discussants and the question raised by our participants, both physically here and online, will provide the opportunity for a more in-depth, comprehensive conversation about building a stronger, more agile, flexible, and resilient banking system to support the economy. I wish us all a productive deliberation. Thank you.
Thank you so much. Please give him an additional round of applause. And that was Mr. Olufemi Awoyemi, the founder and chairman of Proshare LLC. A round of applause. Thank you so much. You fired us also up by giving us some insight into the new report, and I'm sure there'll be further discussions and insight into this report, breaking it all down for every one of us to see the great work that the Proshare team has put together into this report. Let me quickly say, not really introduce, but say good morning and welcome to other members of my panel as they come in and distinguished personalities. Let me say thank you very much for coming in early and sitting in even till now. Dr. Omolara Akanji, the head of research and strategy at the CIBN. Dr. Omolara, thank you so much. We appreciate your presence. Let me also recognize, thank you very much for coming. Although I mentioned one or two names in absentia, Dr. Biodun Adedipe, the CEO and Chief Consultant of Biodun Adedipe and Associates, thank you very much. Dr. Ayodeji, Ebo, Managing Director and Chief Business Officer at Optimus by Afrinvest, a licensed market professional, an analyst, and everything else in between. Now, the man sitting between both Dr. Adedipe and Dr. Ayodeji Ebo is the CEO and Managing Director of NESD OTC Securities Exchange. Please put your hands together for Mr. Longe. Thank you very much for coming in this morning as well. We appreciate everyone's presence. Let me build very quickly on what Olufemi Awoyemi, the chairman of Proshare, gave us just a few minutes ago, and asked Mr. Tosin Ige, who is the head of research at Proshare, to give us a macroeconomic overview of Tier 1 report of the banks, bigger, bolder, and more dominant.
Thank you very much. All right. Good morning, everyone. Standing on existing protocol, I would like to take us through a brief review of the macroeconomic conditions within which the report is premised. And in that, we're basically looking at what has changed and the drivers of those changes. For us at Proshare, we believe that choices have consequences. And the choices we made some years ago is the outcome we have today. And so, the same way, the choices we are making now will determine 2030, which is the $1 trillion economy that the country is trying to project. But in doing my review, I will look at it in three headings. I'll look at the global and the African context, then look at the Nigerian economy, and concluded with the sectoral growth and reforms. Okay, so for the first one, the global and the African review. Now, two concepts define the global economy, as Mr. Uyemi has mentioned earlier: geopolitics and geoeconomics. Now, it has become a chessboard. The global economy has become a chess of, geopolitics and geoeconomy. And because of that, we've seen the level of uncertainty increase so significantly. Looking at the chart, you see that from the Trump 1.0 era, we've seen that increased volatility. And of course, in moving into the COVID period, through to the Russia-Ukraine war, and then the current tariff, what we are seeing, heightening the level of uncertainty. Now, but picking it one by one, the geopolitics. You will agree with me that the world has become fragmented into blocks. And of course, it has implications for supply chain, for energy, and for investment flow. But this geopolitics is actually driven by three factors that we listed there, which is the rising geopolitical rivalry. We all know what is going on between the US and China. We know Russia, Ukraine, and we can continue to go on and on of the rising geopolitics that we are seeing in the global economy. And another driver is the increased quest for national security. Everyone is going on the protectionist policy. And then that is fueling the geopolitics that we are seeing on the global economy. We've seen the rise of friendshoring, onshoring, and the rest of them. And lastly, the BRICS and others, who may be silent anyway, have actually been looking for alternative to the dollar dominance. And so that continues to fuel that geopolitics. But looking at the second one, we see the geoeconomics. Now, this is basically driven by the US tariffs, as we mentioned, the retaliatory tariff, others. So we keep going back and forth. I think there was a new concept to develop, something around taco, which is Trump always checking out. And because of that, which I've mentioned in the uncertainty that we've seen, there is so much that alliances has become fragile. So each economy, the era of multilateralism has broken down. And so what we see now is the unilateralism and the bilateralism. You have to engage on the country level because some world organizations, the likes of UN, WTO, are actually losing their relevance, permit me to say that. So for the African economy, moving on to the African economy, the same thing is happening for the African economy. We've seen Africa also being fragmented into blocks. Now, on one hand, there is the fact that there are some alliances that are shifting to the BRICS. On the other hand, there are those who are playing neutral because no one wants to get into their war. As I think it was Dele Faro to me that said, don't die in their war. So that's what we see many African countries pulling back and just watching what is happening on the global scene. But one thing can be sure, that there is a quest for Africa. Because of cheaper resources, we are seeing that quest for Africa, and everyone is moving. But of course, as I said, there are implications that AfCFTA as it is was meant to become the unifying factor. And so because it's yet to take shape, we still see that fragmentation in Africa. The likes of AES are recently pulled out of ECOWAS. So let me move to the domestic scene. Now, on the domestic scene, I'll try as much as possible not to bore out with data, even though at Proshare we are very big on data, but I'll try not to bore us with that. Looking at the macroeconomic dashboard, I'll look at the three. Look at the GDP, the exchange rate, and the inflation. And when you look at, these are actually what happened. These are actually what happened in 2024. GDP increased, exchange rate depreciated significantly, and inflation also rose significantly. But when you put it into context of the current Q1, we've seen that the NBS has not released the GDP figure, but our own extrapolation suggests that we still see improvement in our GDP figures. And we know inflation has gone down, even though it is methodological, but we've also seen some level of moderation even with the current metrics. And of course, the exchange rate, seeing relative stability in the exchange rate. So which suggests that on the macro scene, we are relatively stable, and growth, we are growing. But when you look at the micro analysis of it, pay attention to three. Pay attention to the food inflation, pay attention to the capital income, the electricity per unit, and of course, the minimum wage. Now, when you look at food inflation has increased, it increased in 2024, as I said. Per capita income is rather low, from 1,600 somewhere in 2023 to around 877 in US dollar at this period. So when you look at minimum wage, truly minimum wage in Naira has increased, but when you dollarize that, you find out that an average worker has actually become worse off in dollar terms. So that's the reality for the micro segment of the Nigerian economy. But as I said, for the macro, there are improvements. And this chart tends to show that when you look at the orange slide there, which is the business confidence, businesses are confident of the economy because of the series of reform that has been launched. But when you look at the household confidence level, it is still in the negative territory, to show that all households, all are feeling the brunt of the policies that are coming on board. I told someone that the policies are theoretically right. If they are to come to us at Proshare, those are the things we recommend. But yet, it's just the transition period. And so household may not be better off in the short term. So that's what we are having. And the PMI also shows that increase. Now, the exchange rate, as I said, for 2025, we've seen relative stability, but of course, it comes at the expense of the foreign reserve that is to the right. Now, our trade figure largely, move to slide up, move on. Our trade figures has also shown some optimism. We've seen trade surplus increase. We've seen FDI inflow also increase. But all in all, these are the macro segments, because we are beginning to see, when we started the year, we begin to see the profit or the gain from the series of reform that has been launched by the Tinubu administration. If you go back to the slide before this, we've also shown, according to the FRED that track the index level. On the global scene, I talked about the fact that uncertainty level has increased. But when you come to the Nigerian scene, now the uncertainty that we actually record, that increase was due to the global event. But when you see 2025, we've seen 2024, 2025, we've seen some level of reduction in the level of uncertainty, because, as I said, businesses are actually optimistic of the Nigerian economy. So that's what the chart is showing. Now, moving to the last segment, which is the sectoral growth and reform. Now, the sector that continue to contribute to the Nigerian economy remain the agricultural sector, ICT, trade, financial services. Those are the sectors contributing more to the Nigerian economy. But we are yet to see that filtering into the market, because in the market space, we've seen the oil and gas led the NGS last year, the accent, the insurance, the consumer goods, which shows that disparity. But we are quite bullish that with the current reform that has been launched by this administration, we may see that reversal. Now, in our own analysis, we believe that the current policy action by this administration is a combination of both reforms and what we call policy progression. To the right is what we say that is actually the natural progression of any economy. One, there will come a time from the Emefiele era, we have continued to see the CBN intervention. And of course, they also, in one way or the other, mentioned that inflation is what they are targeting, though they had some quasi-fiscal intervention. But it is just the natural progression of things. But when you come to the segment of the reform, we believe that the the fiscal and tax reform, their reforms, the student loan, local government autonomy, PIA, these are the core reforms. And you agree with me that just as Mr. Femi Awuyemi mentioned, the MTN era, the telecom licensing of those era was a reform that triggered, that filtered into other segments of the economy. And so we are also bullish that these reforms on the left-hand side are actually reforms that can deliver such a movement for us if handled properly. To go into that, one of those reforms that we mentioned is the tax and fiscal reform. Permit us to say that the reform as originally intended by the committee, we are so big on that. But until we see what the outcome has been, because we've seen series of change, until we see the outcome, we may not also be that bullish. But as an organization that track many of those things, we also, when it is assented, we'll look at it again, and of course, we prefer our own opinion. This is because we are interested in the personal income tax, the corporate income, the VAT, as well as the streamlined revenue collection process. So this is one of the reforms that we are actually bullish on, and we are monitoring to see where it leads us. Now, going again into the next one, you see that from the right-hand side there, the reforms that were launched recently by the Tinubu administration, we've seen those things we've seen that inflection that they triggered in some of our macro data. Now, what the implication has been is what I've mentioned. For the macro segment, is delivering gain. There are benefits that businesses and the economy is seeing, but of course, for the household demand, we've seen it remains on the negative territory to show us that. Now, I'm mentioning the micro segment because for us at Proshare, we believe the household as SMEs are the common denominator of every policy. And so your focus, even though you are launching a policy, should be how does it better the life of household and SMEs. But as we had now, the household is still worse off. Okay, moving on. Now, we've seen, I would like to talk more into this, but we'll see that because of the policies introduced, advised by some international agency, we've launched them, and of course, we've seen some upgrade from Fitch and of course from Moody. Anyway, we are still in the junk territories. But if they continue, if they sustain the reform, possibly we'll move into the investment grade. Now, this shows us our expectation in the reforms, as we have said. In the long run, we believe that we are better off. Now, you look at the legend, there is a decrease, but we are not seeing decrease in any of this reform, unless it is politicized. That's when it may not materialize, but we are quite bullish on all those reforms. And the next one is what the chairman has mentioned earlier. Earlier in the year, we did an extrapolation of the GDP when the MBS said they were going to come up with the base figure, and we preempt that to extrapolate the GDP, and we actually divide the economy from the 46 of the MBS, we streamline it into 14 sub-economy. And the purpose is to show that the 46 economy may not allow for streamlined management. Some economy may be subsumed under some other economy. So we presented it in 4 key areas, and we are bullish that if the government monitors the economy in this light, we are actually going to achieve more than the $1 trillion economy that we project to achieve. Now, let me conclude by saying that from the global economy, it's all uncertainty. But in the domestic economy, it's reforms after reforms. But the consequence, as its way, for now, is that the macroeconomy is seeing relative stability and, of course, maybe relative growth. But the reality for the macro segment is still uncertain. It's pain, as it were, for now. But we believe that if governments can actually consider some of our recommendations, for instance, the economy, rejigging the economy, and other instance is equity financing, because we have so much been in using debt to finance our system, which tend to crowd out to the private sector. We believe if the government look at equity financing, either you want to look at the public or the private equity, we may deliver the growth, or even more than the $1 trillion economy that we are projecting by 2030. Thank you very much.
So much, and that's so much of the passion that you have at Proshare. Please put your hands together for Tosige. That was what I describe as the helicopter view of things, from global to Africa, and then a couple of domestic macroeconomic environment. Thank you, Tosi, for walking us through that. Now, if that was a helicopter view, now let's get what we call a bus ride into the Tier 1 Banks report itself. And just building on that momentum, presentation 2, let's put your hands together for Teslim Shitabe, the Director and Managing Editor at Proshare, who will speak to us on Tier 1 report findings.
Thank you very much. Good morning, ladies and gentlemen, and you're welcome to our launch. The chairman has made very salient points concerning the importance of the banking sector in supporting the Nigerian economy. And my colleague Tosin has also mentioned the target of a $1 trillion economy. In so doing, he has indicated the direction of my own conversation as it relates to the report getting bigger, braver, and dominant. My presentation will cover 3 things. The first will be an overview of the Tier 1 Banks report and our fit-for-purpose methodology. The second will be the new class of 2025. Who was in? Who went out? As the chairman and Mr. Olufemi Aoyemi had pointed out earlier, the whole concept of the Tier 1 bank analysis emerged from an earlier study done in 2013 by Messrs. Afrinvest. And I'm very grateful that one of the persons that were part of the team that pioneered here with us, Dr. Ayodeji, Ebo. Thank you very much for coming. Yes, he deserves a round of applause. We looked at what Messrs. Afrinvest had done then, and we felt there's a need for a slight change in methodology and a recalibration of the various institutions. I will take that in the second part of my review here. Now, the final part of my review will just basically give an insight into the new banking recapitalization playbook and our closing thoughts as an organization. Okay, right, so as a background to our report, we looked at the transition that is taking place in the financial services sector. One of the things we've noted is that organizations have decided to become flatter, faster, broader and deeper technology application. There's been increased flexibility and agility, and a new concept has emerged called headless banking. It doesn't mean that the banks are decapitating people's heads. What it does mean is that they're basically separating their back office functions from front-facing functions. I'll take that when I look at the implications of neobanks and how banks, how conventional banks will collaborate and compete with neobanks. Next slide, please. Yes, so we looked at what Afrinvest had done in 2013, in 2002, 2021. And we decided that was it actually a fact that tier 1 banks are fixed? It was what then Afrinvest called fugas. Fugas. You had First Bank, you had UBA, you had GT Bank, you had Access Bank, and then you had Zenith Bank. But why should these banks alone be tier 1 banks? So we took a look at the numbers, which basically was heavily skewed towards their asset size. And we discovered that there might be a need for a readjustment in the evaluation process. And so we introduced a few more variables. In our first report in 2021, we brought in Fidelity Bank, and we took out First Bank. And that was based on the data available at the time. However, interestingly, we have gone back to the past. So the future and the past are almost the same now, because we've gone back to, in our current report, we've gone back to fugas. But our own fugas has an E, unlike that of Afrinvest. Our E brought in ETI. Now, ETI comes up with its own complexities, which I will discuss shortly. Right, so, yes. So if we look here, the first edition we did in 2021, we looked at the capital adequacy of the banks, we looked at non-performing loans, we looked at the liquidity ratio, and then we introduced a governance metrics, diversity of the board. In 2022, we looked at almost the same ratios. However, when we came to assets, in 2021, we didn't include assets. We included assets in 2022. But in 2022, we broke the assets into two different considerations: asset growth and loan assets. If you also compare 2022 to 2021, you'll see that in the area of profitability, we introduced earnings growth and net interest margin. And in the course of this conversation, I will explain why that is very important. We also took measures of efficiency, and we looked at cost-to-income ratios. We looked at digital income, and we looked at e-banking. As all of us know, e-banking is a very major issue in the current environment. But as much as it has influenced the past, it's going to influence the future more intensely. And I'll explain that to you later. So we also looked at another governance metrics, which was the share of independent non-executive directors. The argument at the time was that the more independent directors you have in a banking institution, the more likely that the decisions of that bank will align with the interest of shareholders rather than the management of the bank alone. So we brought that in as a significant metrics. 2023, we decided that share capital, share premium, share capital adequacy, and virtually most of what we saw in 2022 were important. However, we did add another variable: board gender diversity. We asked ourselves the question, does it matter how many female you have on a board of a bank? Well, the answer will come out in the analysis. But we felt that it was important for us to understand whether gender was critical to the efficiency and effectiveness of banks. So we came up with what we decided to call the Proshare Bank Strength Index metrics, where we looked at two types of banks. We looked at the banks that were tier 1. Those were the top of the tree. And we looked at banks that were tier 2. Some of those tier 2 banks actually were aspiring towards tier 1. And it was just that they were knocked off in one or two metrics. That's why they didn't qualify as tier 1. However, going forward, we expect that many of them, and we'll show that, many of them will actually transmit into, and that's why we call it translation in the chairman's speech. We will translate into becoming tier 1 banks. And I'll show you why. Okay, so this is the big database, which I won't go into the details, but we can see that if you look at what has happened, we looked at capitalization of the banks. And that's on the left-hand side here. We can see that many of the banks have already started to get to their aspirational levels of share capital. This was as of 2024. 2025, they've done a lot better. Actually, one of the banks has gotten to 900 billion naira in share capital. But the argument here is we've seen ETI, it hasn't hit 350, it was at 353.51 billion naira. Access was at 594.90. First hold code, 251.34. Zenith, 614.65, and so on. So that was in terms of capitalization. But to qualify as tier 1, capitalization is not enough. We also took other things into consideration. So we looked at the CAR, that's the capital adequacy ratio. We looked at total assets of those institutions. We looked at the loan assets of those institutions. We looked at the asset growth. We looked at the non-performing loan, which we consider to be very crucial. The quality of your loan book is as important as the size of the loan book. So we took that into account. We looked at the cost of risk. How risky are the activities of the bank? So the cost of risk is there. Then we looked at earnings growth. At what pace are you growing your earnings? Which fundamentally affected the shareholder values. The faster the pace at which you grow your earnings, the better the shareholder value. We looked at net interest margins, and we did a ranking. And so we talked about the class of 2025. This, ladies and gentlemen, is the class of 2025. In tier 1, we have at the top ETI, we have Access Corp, we have First Holdco, we have Zenith, we have UBA, and we have GTCO. And I talked about some banks being at the fringe of that tier 1. The fringe of the tier 1, you would see banks like Fidelity and FCMB. I won't want us to go too much into the methodology, but that is what we have. These banks collectively are called FUGAs. They dominate, and we talked about domination. They dominate market capitalization. Could you kind of go back to the previous slide? Yes. Now, we found out that the average tier 1 bank had 3 times the cumulative capital of tier 2 banks. We also found out that in terms of asset size, the average tier 1 bank was 6 times the size of an average tier 2 bank. And then we looked at the loan asset, the size of the loan assets of the bank. The average tier 1 bank is 6 times the size of the average tier 2 bank in terms of loan assets, the loans they've been granting. And we felt that that was fundamentally important, because it does suggest that it's a really big leap to move from a tier 2 bank to a tier 1 bank. It means you need to grow your assets aggressively, you need to grow your loans and advances aggressively, and you have to improve your earnings. Is that possible? Yes. And I'll show you some of the things that some of the banks are going to do. Could you still stay on that slide, please? Thank you. ETI was in the top spot. And one of the things you note here is that, is ETI a Nigerian bank? For us, that was an important consideration. In the past, we have all ignored it, whether a bank was anchored in Nigeria or whether it was anchored or carried a flag elsewhere. In this report, we mentioned the fact that it's tricky to compare banks nowadays, especially because of the holdco nature of those banks. ETI came up tops, but there was a challenge. And the challenge basically was the fact that ETI currently can stay at 353 billion naira as share capital, but its subsidiary is at 201 billion. Okay, so yes, it has market capitalization that is large, but in terms of the operating entity in Nigeria, it's much lower than that international entity. Creates a bit of a problem. And where is that problem? The problem is the fact that I'm comparing with, for instance, a First Holdco that will perhaps surpass the 500 billion naira. But ETI can stay at 353. Can stay there because it's outside the country, right? Its headquarters is outside the country. So all it needs to do is to ensure that the subsidiary meets that minimum requirement of 200 billion naira. And once that is done, it's fine. But that doesn't mean that it's not part of the group, and it cannot leverage the group to continue its transactions. So comparability is becoming increasingly complex when you have holding banks. And that's a major aspect of the report that we highlighted. Could you go to the next slide, please? Right, so as I had said earlier, in 2024, based on the results that we analyzed, these banks are considered to be tier 2 banks. These banks, well, these banks here are tier 1 banks, most of them. But we expect to see a migration from 2024, by 2025 year end, we expect to see these banks move up to tier 1. Have you noticed something? These 2 banks are indigenous Nigerian banks. But what would we say about this bank? Stanbic IBTC. Yeah, it's a bit tricky. And that's the decreasing complexity that the reports that Messrs. Afrinvest and Proshare have worked on over the years. We begin to see those shifts in dynamics of banks and the classifications and the import of that classification. So, but for the purpose of this report, what we have said is that, yes, we have the FUGAs as tier 1 banks, quite honestly, that's quite correct. However, this migration is going to lead to a shift. And that shift will see Fidelity Bank, FCMB, quite easy to calculate because all of these 2 banks have to meet that minimum requirement of, they're going to meet, if they decide to be tier 1, they're going to have to meet 500 billion naira. They're going to have to, and Fidelity actually has made that. So they have currently made that. FCMB is heading towards that. But when it comes to Stanbic IBTC, it comes back to the same thing that we saw when we talked about ETI. Precisely how much do they need to raise? Could we just do 200 billion for the local Nigerian Stanbic IBTC? I mean, that would, even in fact, as it is, they have more than that. So yeah, that's okay. They're operating in Nigeria. But the group will be, you can leverage the group to be doing transactions cross-border. So the cross-border issues become a point where we'll have to do some deep analysis. Can we go to the next slide, please? Right. So in this particular report, we decided that it was not just enough for us to look at listed banks. Let's take a look at banks that are not listed. Banks that are not listed, the assumption is that, look, these banks are small banks, not particularly too important, but that is not the case when you see what we have here. First and foremost, because of the capitalization requirements, all these so-called unlisted banks must meet minimum capital requirements. And that is 200 billion naira if you want to do national, if you want to take a national license, 500 billion naira if you want an international license. I'm aware that some of the unlisted banks are thinking international, and they're making extreme efforts to raise the capital to 500 billion. But many of them already have gotten to 200 billion. So it now becomes an issue of, is it important to be listed in the market? Now that's something we answered, that's something we answered in the report, so I'm going to tell people to read the report if they want to get the answer there. But the important thing is that we can see the comparative analysis of banks that are not listed with those that are listed. So these are the listed banks. Here, no, this is not listed. This is not yet. Well, Globus is not listed. Premium Trust is not listed. Optimum is not listed. Polaris is also not listed, right? So this is their positions currently. But it has shifted a bit since our report, because this refers to their 2024 accounts. But they've improved upon some of these figures here. But it was interesting for us to just take a look at it. And you see, average for tier 1 banks, if you look at share capital as of this date, it was 170 billion naira. And if you look at the average for tier 2 banks, you saw that they were just 13.72 billion naira. A massive, massive difference of over 10 times. But if you look at share premium for tier 1, average tier 1 banks was 209. For average premium for tier 2 banks was 123. Then let's go quickly to the assets. The average assets for tier 2 was 4.8 billion. The average assets for tier 1 was 31 billion. So in all cases, being bigger appears to be better. It does not necessarily mean that it is so in all cases, but in general, bigger is better. And therefore, it's not surprising that we talked about banks being bigger, bolder, and dominant. The dominant aspect we'll talk about shortly. Can we go to the next slide, please? Right. Now, here we describe the ecosystem of the Nigerian banking sector. And this is where I said I would talk about neobanks. The financial sector in Nigeria has become increasingly sophisticated. We might not have done all things right, but when it comes to finance, I think Nigeria's banking sector and financial sector in general is one of the most sophisticated on the planet. And I think Nigeria deserves a round of applause there, please. Yeah, our financial sector is one of the best globally. And the evolution of that sector is interesting. Currently, we have 27 commercial banks, we have 6 merchant banks, 6 development banks, microfinance banks, non-interest banks. Yeah, that's a place where Nigeria is also growing, the non-interest banks, non-interest window banks, and then we have mobile industry banks, we have primary mortgage banks, and payment service banks, PSBs. Now, what direction is the financial services system likely to head towards, given the current ecosystem? One of the things that is going to be dominant, and I think Mr. Olufemi Awoyemi mentioned it in his speech, is that big banks are going to swallow smaller banks up for breakfast. That's Proshare's position. We believe that big banks will not only swallow smaller banks, big banks will swallow neobanks. The fintechs have done brilliantly. They've improved penetration, financial penetration. They've done that well. They've gotten to that point. But there's a caveat. So far, they've been depending on venture capital funding. At a point in time, the venture capitalist will ask for returns on his investment. None of them, to the best of my knowledge, or to the best of our knowledge as Proshare, has turned a profit. None of them has turned a profit. So it's a situation where we expect going down the line that investors will ask for profit. Also, another issue is that as they get bigger, there's a need for greater compliance with regulatory requirements. And I think Mr. Olufemi Awoyemi mentioned that. Now, with the greater need for compliance, it's going to be tougher to make the kind of revenues that they've been making. And if that is the case, you have two options. Either you go out of business or you sell your business. We believe that many of them will not go out of business, so that's not a problem, but they will definitely hand over those businesses at a good rate to the original investors. They will hand them over to the banks. And we are seeing a larger collaboration between banks now, and that's conventional banks and the new banks or fintechs. So this ecosystem more or less gives us the idea of how the financial services sector in Nigeria will play out. Now, the recapitalization playbook, we expected to see, and we have seen, larger local market competitiveness. We've seen upscaling of human capital. We've seen greater capital efficiency in the banks. And then here, we also have seen a growth in on-balance sheet transactions. Now, this refers to the earlier playbook, post-Soludo. That was the earlier playbook. The new playbook shows something a lot different. In the new playbook, we expect to see technology being critical in the evolution of the system. Less human-to-human interaction. With the advance of blockchain technology, like the chairman, Mr. Olufemi Awoyemi, had said correctly, blockchain technology, artificial intelligence, all those technologies will come to play in the new banking playbook. Human capital will have equally significant importance. Will there be an elimination of capital? Yes. But human capital of a particular type. So it is the type of human capital that will be critical in the new playbook. I perhaps may not need a front desk officer, all these other kinds of things. That's why we talk about headless banking. So we're not looking at all those normal back office transactions. I can give you a P&L of a bank almost instantaneously. I can give you day to day. Because the system itself, based on artificial intelligence, as long as the algorithms are properly structured, it will give me everything I want. So I know what position I have daily. So I don't need a human being to start giving me reconciliation of day end and all those things that we used to sweat over. So there, in those basic back office functions, maybe there will be a loss of job. But it's not a total loss because you need certain categories of employees now. Marketing can't be done by an AI. I mean, they can push some things online, but we are still essentially, for now, a human society. So human-to-human conversations are important. And if I wanted to, for instance, give a loan, I perhaps want to explain to somebody the nature of my business. So somebody has to have the knowledge of that business and the kind of loans that I can give for that business. So people in that credit function may also still play very critical roles. Corporate governance. Sorry, could you go back quickly so that I can also... Corporate governance will also become increasingly important. Let's put it this way very quickly. One of the reasons why we had challenges in the first Soludo need for reconsolidation was basically here. This was where the key problem was. Corporate governance. This will improve significantly. Financial leveraging. One of the things that we have done badly in the financial services system is leveraging. We expect that in the new playbook, leveraging will improve. Now, this is where I want to emphasize the difference between this on-balance sheet and off-balance sheet transactions. The new world is a world of off-balance sheet transactions for financial services institutions. You're going to see more transactions that are less old school and more sophisticated in their applications to specific needs. These needs that emerge will be unique. And so you're going to see banks want to do things where there are a lot of fee-based transactions taking place. So there are a lot of off-balance sheet activities. Okay, could you go to the next slide? So that we can quickly go through, yes. So, go to the next slide, please. Okay. So, looking at the recapitalization playbook, we've seen that these tier 1 banks, this is what their target is. But like I had said earlier, most of these banks have either met it or are close to meeting it. But look at the anomaly. Here we said target, 500 billion naira. But look at ETI. And that's where the analyst's dilemma comes from. So if I have tier 1 banks all targeting 500, how come this targets this? But that also might be a mistake. Because like I said before, the institution actually listed on the Nigerian Exchange Limited is not the institution, this institution, which is actually EcoBank Nigeria. EcoBank Nigeria currently has 201 billion naira in share capital. So it has already met that. But the institution we are comparing with is actually ETI. And that has 353 billion. So which institution should we be calling tier 1? I'll leave that for you to answer. I'll leave that for you to answer. But yeah, so this is basically the data set for that. Okay, so we've seen that the current capital for Access Corp is 594 billion. They've exceeded the requirements. We have Zenith 614.65, and I think GTCO 346.30. So most of them are quite in good shape. Of course, First Holding, I can assure you that before the date, and the chairman has already said it himself, before the date, they will be much higher than 500 billion. Let me just put it that way. They'll be much higher than 500 billion. And then UBA, obviously, they'll be much higher than 500 billion. But the only one I think will stay at 353 or thereabouts will be ETI. So it leaves us with the dilemma that the experts here, it's good that the Institute is here. It's good that we have BA Adedipe here. So these are things we need to resolve in the basis of the next report that we will do at the end of the year. Thank you. So please, the next slide. Yeah, so my closing thoughts here. Most banks that had international licenses fell within tier 1 banks, and that was natural. Like we said, being bigger, bolder, and dominant is the name of the game. You need to grow yourself to be able to be dominant and to be able to earn the kind of revenues that will ensure that shareholders are happy. So being bigger is important. Now, here, like I've always said throughout the narrative I've given, the holdco structure has given us a bit of a challenge in interpretation. But it's something I think we will get over, because I know that there's another bank, as a very good bank, and perhaps is one of the forefront banks in terms of technology. That institution is also going holdco. And if it does go holdco, well, we'll have to look for some more matrices to calculate who tier 1 is and is not. So, like I said, why is it necessary for us to have larger capital? I think the chairman mentioned the point that it is important to have larger capital. When you dollarize the capital, even the new capital of Nigerian banks, when you dollarize it, we're still not where we were a few years back. So it wouldn't be strange if another round of recapitalization takes place not too far off. And we need to prepare ourselves for that. That there might be another need for recapitalization of banks. And if we're going to grow, like my colleague said, a $1 trillion economy, you need large-sized banks to be able to support. I'm not saying that they will ensure, but they will support that aspiration of a $1 trillion economy. Now, the way it is now, and for you to understand it in context, if we assume that GDP is about $200 billion, from now till 2030, the economy would have to grow, because it's 5 times, so you're going to have to grow at between maybe 16 to 18% per annum. That's virtually impossible. 2023, we were at 2.9%. Last year, 3.4%. This year is estimated that it's going to be 3.6%. So we are way off from that. However, my colleague has pointed out, Proshare has reworked the GDP calculation. And in our calculation, the Nigerian economy is about at least 2.5 times what most people think it is. It's much larger than what most people think it is. We are still awaiting the National Bureau of Statistics official rebased GDP. However, we do believe that it's going to be much higher than the $200 billion that is quoted. So maybe we need to grow at between 7 and 8%, as the chairman had mentioned in his paper. That would be more, I don't want to use the word reasonable, but at least it will be a more modest growth rate for us, which we think can be attained if certain prescriptions that Proshare has made over the years are adopted. Ladies and gentlemen, I want to thank you.
You know, the difference between a helicopter view and a bus ride. On the bus ride, you get a whole lot more on the ground, right? Helicopter just give you a very nice overview. Thank you to both Tosin Ige and Teslim Shitabe for the macro and the micro perspectives on this report. Now let's move on to the discussion and my panel that will discuss that. Let me say thank you to the Chief from the Institute of Taxation. Thank you very much, sir, for coming. The CITN. Please give a round of applause to a friend of the house, Dr. who just came in. Thank you so much. We appreciate your time. And Kunle Aderinokun from Access Bank. Please give him a round of applause. One of us and a friend of the house as well. Now, I'm not giving you the microphone to comment. You're from Access Bank, so you're among the full guys. So, very interesting. Let's discuss this further, because now we have the money on the table. What do we do with it? So, let me bring my panelists to the table. Let me start with Dame Dr. Omolara Akanji. Please welcome Dr. Omolara Akanji. Yes, you can use any of the yes to come to the podium. Madam, thank you so much. She's a former director in charge of Trade and Exchange Department at the Central Bank. She retired from the Central Bank in 2007 and recalled as a consultant to the governor on statistics at the central bank from 2008 to 2011. Dr. Akanji has a PhD in finance from the European American University. She's an alumnus of the Harvard School of Governance, and she's an independent director of Sterling Bank, an independent director of InterSwitch Company, and also on the board of so many other organizations. Thank you very much, madam, for coming. Just for brevity. Dr. Biodun Adedipe, FCIB. I'm sure you're home. This is a CIB, and please a round of applause for him. Dr. Adedipe is a founder and chief consultant at Biodun Associates Limited, BA Consult, 4 decades of professional experience. And the first item listed on his profile is a university teacher. Please give him a round of applause. Not as a banker or as an economist, but as a university teaching. Whoever wrote this did a very good job. Of course, he's been a member on a couple of government projects, including the Presidential Committee on Redenomination of the Naira, a member of the Federal Government Committee on Experts on Expenditure Review, as Senior Special Assistant to the President on Financial Sector Development, and Chief Economic Advisor in 2011. Now, let me also introduce Dr. Ayodeji, Ebo, FCCA. Please put your hands together for the Managing Director and Chief Business Officer at Optimus by Afrinvest. He was the Managing Director of Afrinvest Securities Limited. He has had experiences, over 18 years of experience at Chapel Hill, Denham, Greenwich Merchant Bank, and other reputable organizations. One of the few individuals that I've interviewed most in my career. A round of applause to him. He's competing with Dr. Adedipe when it comes to that. And finally, Teslim Shitbi of Director of Research at Proshare will be joining us. Let's put our hands together. My Director, Managing Editor, please. Thank you. Oh, yes, that's the representing our landlord. Please put your hands together for the CIBN. Yes, that's the name I mixed up, my apologies. That's Dr. Boason Omofaye, Head of Research and Strategy at CIBN. Thank you very much. He's representing the president of the CIBN, Professor Lariwaju, on the panel. Thank you. Shitabe, don't go too far. Come to the front. We got a few more questions for you. Just step forward here. I'm sure we'll get a few more comments and questions. I'm sure we all have microphones over there, just to make this a little bit easy and for each one of us. May I pass this to you, Doctor? Okay. This looks a little bit tricky. And why do I say tricky is the fact that I have my own thoughts when it comes to some of these issues, but I'm here to listen to my panelists. And the panel is a little bit fairly balanced. From the macro, the central banking, and of course from investment and markets perspective, looking at the new report of getting bigger, braver, and dominant. But let me tee this off from the macroeconomic environment, and I want to Adedipe to tee this off for us. So the banks are coming through right now, putting the recapitalization money together. The deadline is just about 9 months, technically, away between now and the end of March next year. So we have an environment of macroeconomic headwinds, cost pressure, high inflation, or elevated inflation, exchange rate dynamics. So how do you think the banks will be able to balance the pressure of supporting national economic growth and their fundamental objective of generating sustainable profit for shareholders? Is there a microphone over there? Oh, sorry, my apologies. I should have put that there.
Thank you very much, Boason. And let me also say a very big thank you to Proshare for having us together here. Now, the issue of banking and the macroeconomy, I will start by putting it in perspective that originally, that's from the foundation of banking historically, banking business is meant to be a derivative. It's not a standalone as a business, but as a facilitator. And it seems over the centuries, banks have drifted away from that core role of facilitating, but now standing as a business on its own. So in which case, we now see banks more as business rather than being drivers of economic activities. So conceptually then, every time we do recapitalization or there's reform in banking, it's an opportunity to take a second look at banking as a core aspect of the national economy. And I'll give two quick illustrations. Now, we've had over 800 years of banking crisis, that is financial crisis over centuries. We've also had occasions of banking reforms across different geographies. At every occasion this happened, the condition is always, can we get banks to return to the basics of the business? And I will also say, I had a thought in that, you know why? But sometime in 1999, of course, the bank is dead now anyway. I was invited to Maiduguri to address the board of directors of one of our banks, one of the leading banks in Nigeria then. And this issue came up. So they asked me this same question. And I recall telling the chairman of that board, I said, look, your concern should be your business. Leave the economy to the government top functionaries. But over the years, I mean 99 to now, is quite a number of years, my opinion has changed. And I think that is one thing we should consider here. That yes, it's good to pursue profit, quite all right. And banks are very good at that. And why do I say that? Because our banks are very good in strategy. And they invest in it anyway. So I don't, therefore, have any issue with banks making profits. But then that must be balanced with how we connect what they do with the rest of the economy, especially the real sector. And that is where I think they should pay more attention. Capital is good, yes, they become bigger, and they have more muscle to finance transactions. But let them focus more on where the problems are. And again, ultimately, it's to their benefit. But the more connected they are to economic activities, the more money they make. So it's not mutually exclusive. That's my final answer.
All right, thank you, Dr. Adedipe. Give me a round of applause, please. Let's motivate my panel. Thank you for that coaching result. Let me come to my neighbor, my closest neighbor, Dr. Adedipe, when it comes to this particular issue of balancing national economic development and deploying this very huge capital vis-a-vis remaining profit and returning decent and mouth-watering returns to shareholders. What's your take on that? Give me your opening thoughts.
Well, thank you very much. And let me also say a very big thank you to Proshare for this opportunity. We so much appreciate for this program that is coming up at this particular point in time. Well, from the name commercial, banks, they are established to make money. So from shareholders' point of view, from the owner's point of view, they must make money. But the type of money you make is what is essential. They are putting a lot of things together to ensure that returns are given to the owners of the bank. Nevertheless, all these are also added together to the computation of GDP. Because when you make money, when you grow, at the end of the day, when you compute the contributions to the gross domestic product, you see that it's on the high side. On the other hand, banks are also expected to contribute to national development of the country. In terms of employment, they generate. In terms of businesses, they finance. In terms of taxes, they pay to government. In terms of the contributions to the economy, in terms of social contribution. So when you marry the two, I think they are doing what they are established to do. Thank you very much.
Thank you, Dr. Akanji. Let me come to you, Dr. Adigun, sorry. Let me come to you, madam. Now, from your experience in central banking, the banks are bigger. They're going to get a whole lot bigger. And Teslim was saying, look, there will be another round of recapitalization, maybe 5 years down the line, 7, 10, wherever. But the capacity to regulate bigger companies, banks, and then quite a number of them in the holdco structure, in which what we see now more is the holdco structure. That's what goes out more. The bank is what the man on the street sees, but the holdco structure is also there, part of the discussion that this report has revealed. How do you think the regulator will be able to handle this in terms of regulatory framework that need to evolve to look at the asset quality of these financial institutions, these behemoths that are emerging, even as they most likely will go, if these predictions come true, to take the lunch from other smaller banks moving forward?
Thank you, the moderator, and I want to congratulate Proshare for this exercise. If you look at their presentation, the answer is already in the analytics that was presented this morning. I was very excited looking at my background. I started in the research department. I was the head of statistics. All the analytics that was presented this morning had indicated the way forward. What we will see in the next 10 years in the banking sector, digitalization will separate the whole core activity. But my concern is whether central bank, as we know it of today, is going to be, at speed with what is going on in the market. Because if central bank is not at speed with what is going on in the market, there will be a lot of distortion. You will see banks declaring, the Fuga banks, they are declaring both interest income and non-interest income. So you cannot really, separate it in terms of regulatory issue. The banking supervisors will come. They will only look at the books of the banks. The whole core, income is also, diluted. It's already in the bigger purse of the bank. So it's going to be a serious problem for regulator. The regulation that will come in this recapitalization or capitalization will be different from what happened in the first capitalization. Because the banks are very smart now, smarter than before. So most of their income, 1 trillion naira profit that they are declaring, is not wholly from banking activities. And how do you dissect that? How do you separate that? So I think central banks should begin to train their staff to be able to be more forward-looking in businesses, in the economy. Because we have other financial departments, what they call OFID. Those ones can be engaged or trained to be able to look at the other aspects of holdco, so that the balance sheet of the holdco will be separated from banking, as it were. That is my dimension. Digitalization can help us to do that, and also the revenue growth in that bank has to be dissected. In addition, is their product, the product they are trading with. For example, GT, in their holdco, they have food,
Yes.
exactly,
Yes.
and they have textile.
Yes.
So those kind of things those products had to be separated. And they are banking those activities. It has to have a different line item.
Oh, good. Thank you so much, Doctor. Let's give Dr. Akanji a round of applause. Let me take that straight quickly to Ayodeji. One of the things that Proshare LLC has suggested is that, look, yes, the Central Bank of Nigeria is good, as it were, but then do we need to go the UK model in terms of separating the Financial Services Conduct Authority, perhaps a little bit like South Africa, and begin to break things down a little bit to achieve what Dr. Akanji has suggested, that of a bigger bank, not just by bank by name, but a financial services supermarket.
Okay, thank you.
Is this something that we need to start considering down the line as we get to the end of the recapitalization program for next year, March?
Yes, I agree, but I would like to appreciate the chairman and the wonderful team of Proshare for this opportunity and for their consistency this year of this particular laudable project. Now to your question. So I think that it's like we're just revolving around the same cycle. So you look at before the consolidation, you see that there was like separations. Banks specialized in different aspects. And later on, they had the holding structure. Then there was a policy that said that they sold off their subsidiaries.
Yes.
Now, they are back to
buying back
again those subsidiaries.
So we decouple and couple back again.
It's just still like within the same cycle. But I feel what we can see now is that there's better regulations compared to what we had in when banks they were doing a lot through their subsidiaries. And with like what Madam mentioned, that there needs to be understanding of how those subsidiaries, how they would be able to play by the books. So you're not using those subsidiaries to circumvent regulations. But there's a need for those financial services. You know, we're in the era of technology, which Mr. Shitabe mentioned on. AI, it's coming in. When you look at even those that plays, you look at the financial technology companies, when you look at transactions that's being carried out by them, so when you look statistics based on NIPS, says that about 40% of the total NIPS transactions were carried out by the likes of OPay, PalmPay. So there's a need to still see how are they able to penetrate. They are getting the volume. To get a loan from Money Point now is easier than commercial banks. And what they use is technology with open banking. And when you also look at the non-performing loan, because of the technology, they're able to look at the behavioral pattern. These are some of the specialization that the banks will need to come in, because banks may take 4 weeks to disburse on that same particular loan, trying to study your behavior, look at all the C's of credit. But if technology can be improved on and can look at your pattern, spending pattern, look at your credibility, get details about you, and pull that down, give a scoring,
and they begin to improve on it. So that is helping them to even go into credit faster than even the commercial bank. So there will be a need that there should be, I would say that they shouldn't separate, but regulations should ensure that they play within the books. Thank you.
Dr. Ayodeji, but let's get to the meat of this report launch and this panel. We need to get the banks to support the economy, whether it is $1 trillion or $10 trillion. And be as it may, no banks print its own money. So whatever deposit they get is from the economy. So I always joke that no bank has any money. He said the shareholders brought the money, and I said, well, they didn't print the money. The money comes from within the economy. So they need to support the economy. I don't think there's any reason why anyone does any business without supporting the economy, whether you're creating jobs and doing whatever. So let me get back to you, Dr. Adedipe, on the larger equity basis the bank will have. There was so much money, $500 billion naira. That's a whole lot of money, going by whatever inflation, exchange rate, whatever, no matter how we slice it. So how do we get this huge amount of money, whether it's in tier 1, tier 2, tier 3, but in particular, mostly for the tier 1, to support the growth of the economy post-recapitalization? We're talking about 9 months, whatever, down the line, and to translate into tangible economic development, job creation, and what have you, rather than just pumping out to shareholders through dividend payment.
Okay. All right. Thank you so very much. Now, the first thing I want us to put to mind is the fact that banks don't lend out of their capital. Capital is a driver of deposits, as you said.
Yes.
But with more capital now in the pocket, it's a motivation to go for deposits, which they will now create risk assets from, generate income, and do all those things that we understand to be additions to the economy. Now, that given, then the other key issue is that when I was privileged to be the team lead for the credit market team, when we worked on the FSS 2020, and we all came to an understanding that if this economy was going to grow, the aspiration then actually was to grow the economy to $963 billion.
2004.
Almost $1 billion.
Yes.
Then,
yes.
That was the aspiration for year 2020. And we said, if that will happen, then the credit market in Nigeria will be the driver of that. So the question now for us is, with banks having huge capital in the outcome of the ongoing exercise, how will that connect to driving the credit market to support the economy and grow its GDP? A number of gaps we saw then in the credit ecosystem. But interestingly, the current Tinubu administration is addressing that, especially with this new institution, credit guarantee, that was just, leadership appointed into it, okay, and the board. Now, what we saw then were challenges to our credit culture, and then banks also holding back from creating risk assets in some sectors because of risk concentration. So what the credit guarantee institution now will do is to de-risk some activities and therefore enable banks to lend to them. Maybe I will suggest to Proshare that in subsequent reports, you probably want to introduce a metric that will help us in this direction, and that is impact. So measure impact. So not in terms of the volume of risk assets or how much income we generate from them, but how many in terms of number, then also in terms of sectors that are impacted by the credit operations of the banks. If we go that route, we get more value from the capitalization outcome. Thank you.
And I think that's what, I think Femi touched on that earlier, when we look at some of the sectors that we need to
exactly.
Logistics.
That's right.
Whether it is blue, green, creative sector.
That's
those
right.
14 sectors that were
Yes.
highlighted. I guess that must be,
Yeah.
those 14 sectors that we need the banks to intervene
That's
and,
right.
and very strongly as well.
Yeah.
Let me ask let me allow Dr. Akanji to speak to that very quickly.
I think we need to, dissect those sectors very, succinctly. And because those sectors that were listed, they have a large proportion, over 60% or 70% will be in the informal sector.
Yes.
And so, if we can address the informal sector within that listed sectors we have,
Yes.
we will kind of, inflate the economy. We will just inject growth into the economy because a lot of informal activities are going on, both non-oil and other extended informal activities. And it is not that the informal activities are not integrated into banking. Let me give an example. If a plumber comes to your house and he does plumbing work for you, an informal plumber, he has no shop or whatever,
Yes.
he gets his money from the bank, doesn't he?
Yes, it does.
So his money is part of liquidity in the bank, the banking sector. But he is not counted. He cannot get credit from the bank, but he saves into the bank. And so his business cannot expand beyond that box they carry all over the place.
Exactly.
So we need to rethink. I think my brother mentioned behavioral. That's what we call behavioral economics. In the behavioral economics, that was what we were taught in the early 1990s by De La Rue for them to be able to print our currency. They want to see the behavior of the economy. How much coins should they print? How much notes should they print? And what is the salary structure of the private formal and non-private informal? It was in that equation to print currency. So if we can study our behavior in this economy and address the credit rating of those sectors, I think we will be a better economy and a bigger economy. We will be more comfortable than what we are currently.
Thank you. Thank you so much, Dr. Akanji. We're having a very important conversation, and why this is the heart of it. The country with the biggest size banks on the African continent today also has the highest unemployment within the OECD countries, and that is South Africa. So when we came up and said South African banks are far much bigger in capitalization and whatever than Nigeria, from Absa Bank to Standard Bank with more than $1 trillion, whatever, they have almost 37, almost 40% unemployment. And 90% of that figure are black South Africans. They have no access to small and medium enterprises fund. There's lack of access of credit. There's access of investment that will drive growth, in which South Africa have seen more than a decade of low-level growth. So the latest OECD report, which came out just a few days ago, said it was a lost decade for South Africa. So even though they have the biggest banks on the continent, they can buy out or buy over many of the banks here and elsewhere on the continent, yet they can't fund growth that will lead to jobs. So how do they get into that morass of a situation? And how do we prevent it? And I think that is what this Proshare report and everything should lead to. Please put your hands together for Proshare. Because it's not enough to just envy the South Africans that they have the biggest banks, but they have the highest unemployment. And there's a big disconnect. The GDP per capita has been at subpar within the OECD countries for the last 10 years. And now they are grappling with the fact that they can't even get the money out of the banks to give to small and medium enterprises and to engineer growth. That's what I'm just getting from that report just a few days ago. So I think this is the heart of it all, that we're going to have bigger banks by the end of 2025, 2026. But how do we translate this money to jobs to help that $1 trillion economy, which Proshare says could go even 3-4 times? We have the potential. Dr. Adigun, let's listen to,
okay.
your thoughts on that.
Thank you.
How do we move the money into the economy and vice versa?
Thank you very much. Proshare has done a lot of work by breaking down the subsectors. In 2024, the total domestic credit to the economy was just a bit above 100 trillion from all the banks. In 2024, and even currently 2025, the current MPR is 27.5, with a symmetric corridor at plus 500 and minus 100. If you look at all those sectors that are listed in Proshare's report, there are a number of them that need money to move, to grow. But how many of them can borrow at over 30% and still generate returns that would give them their capital and a little bit interest on what they have done about? So in essence, I'm saying that the central bank also needs to look at that. If we really want the banks to, if we really want to encourage people to borrow and, move the economy forward. So before now, or even up to now, CBN is using monetary policy to target inflation. And okay, but thank God, due to rebasing, the inflation has come down to something. But since the inflation has come down, and we still want to move the economy forward, there are a number of things that CBN needs to look at, particularly with monetary policy outcomes. If this is done, some of those who are interested in borrowing from banks to move their business forward will be able to do that. Thank you.
All right, thank you so much. Dr. Ayodeji, where do you see investment opportunities, compelling investment opportunities in the years to come, post-recapitalization, maybe for Tier 1 banks, and we're talking about them basically at this event, to support this economic growth drive that we need? Where do you see that as an investment banker?
Okay. So firstly, I would say within the infrastructure space, one of the major challenges with the bank in terms of when you look at their funding structure, deposits, that is always a major part. When you look at we do a maturity analysis, almost like 60-70% would always mature within 90, 180 days. So it limits the ability to fund long-term transactions that are able to operate now. Raising equity, which is more long-term, it also gives them the capacity to participate in more long-term transactions. And like we were speaking for the SMEs, because of the structural issues, that infrastructure, we need to deliver infrastructure to them to be able to bring down the cost of their services and production. So, the more they are also able to bring that down, there's a way it also dovetails into performing loans, because if businesses are able to do well and their margins are also robust, they will also be able to pay back. So there's a need to participate within the infrastructure space. Secondly, agric. The agric, so the value chain, so they may not go into supporting the cultivation, but when we look at the value add, if we identify the top items that we export, starting from that, because it means we already built capacity. If we can export in those quantities, those are top agric, then maybe the top 5, how can we come up with a blueprint and banks supporting? We can see, I think Fidelity Bank is already looking at that space now. All those banks, you can support that. That will generate FX, also generate revenue for the for the banks. And as we add value to those items, not just exporting them in their raw form, we're also generating jobs in the country. So that would really also help. And the last part I would just, because of time, that I would look at is also climate financing. Because for the banks, some of the funds they have, they can use it as part of co-funding. So because of what the world is looking at now, if there are some renewable energy projects, banks they can co-fund with some of the funds that have been set up to support climate funding. And that would also help jumpstart the economy, would also be profitable for the banks and for the SMEs. Then lastly, just responding to your on those SMEs. So for me, my view is always beyond this funding structure or challenges for the SMEs. I feel that there's a need to also reorganize them. So even if lending rate to 15%, the banks will still not lend to a lot of the SMEs because of their current structure or form. There's a need to also build capacity and train them. And lastly, credit scoring used to be universal in Nigeria. Let people know, even from primary school, that there's a need to begin to build a credit score rating that you know and is tied to you. So most people, once you know that, they will be careful, and it will help improve credit and lending in Nigeria, because you know you can't go anywhere. Once you default and you misuse it, it would constrain you from also accessing bigger things even in the future. So there's a need. That's one thing can unlock credit in the system. You look at developed clients, people work, they borrow to repay just to build a credit rating. And you get cheaper interest rates compared to those that have lower scoring. So I think the CBN needs to look at that, and that will help unlock credit within our system. Thank you.
I love that advice on reward system. Dr. Adedipe, I'll give you 1 minute to speak to this, then I'll allow a few interventions in the space of time. Yes, from the floor.
Thank you very much. Now, the response by Ayo has addressed 4 of the 5 major deficits that we have in not only the Nigerian economy, but Africa in general. He has spoken to food deficit by his comments on agriculture, what the bank should do there. He has spoken to infrastructure deficit. He spoke to energy deficit by reference to green energy finance. There is also housing deficit. And in fact, housing is a key sector where when you invest there, you create jobs across diverse industries and sectors, and also create value in the process. And of course, this time around, I'm suggesting strongly that we interrogate affordable housing. Very, very key. Now, if our banks will look in that direction as also opportunity for investment, we can get a lot of value, not only in the delivery of the houses, but also structuring instruments and products that can link developers. Of course, they are the financiers. Then there will be the underwriters as well. And of course, government plays its own role within that space. So I want to recommend that we look at that as well. So that deals with, those key deficits that we have in the. If we focus on them, banking will grow, they make more money, but the economy will also grow.
All right, thank you so much. Let me just take a few interventions from the floor. My panelists, I beg of you, due to time constraints. And then if there are direct questions or observations, we'll take them just about a minute per person. Mr. Lunge, the CEO at NESD OTC. Can we get a microphone? Yes, please.
Brought my bad luck here. Anyway, yes. So I'm listening to all of this, and I'm thinking, where is the solution? So these nice things that we speak about SMEs all the time, I don't think we understand what SMEs are. So the banks are flying at 30,000 feet and the SMEs on the ground, and they are never going to connect. I have these thoughts constantly in the work that I do as to how are we going to bridge this gap of the liquid surplus organizations and the idea surplus organizations. So the banks have the money, but they do not have the style or the appetite to get involved in investment management and investment origination. So you just can't find it. And I'm very happy you brought this up about the South African banks. So you would always have that situation, and I'm sorry, I won't talk too long, I'm going to shut this down. You have what will take us to where we want to go, but the people who have the money are not willing to go there. The banks won't go in that direction, so there has to be a bridge. We're hoping that one of the things that was mentioned in the papers that were presented is that we need to see more equity-type financing. Mm-hmm. Because if you see equity-type financing, you will be able to connect the dots to some of these areas we're talking about. And if you're looking at infrastructure, there has to be a grand plan, and I don't see that grand plan happening. And that grand plan has to work with, I would say, structural markets from the capital markets. There has to be a good handshake between the banks and the capital market, and there has to be trust between them. That trust does not exist, and until that trust exists, you're not going to see the catalyst that will come to generate growth in the economy.
How come there is no trust where there's so much money on the table?
There isn't trust because we're talking about, okay, I'll give you a very good example. Yes. So there's a gentleman who wants to finance a plantain chip business, and he's done a lot of work, he's got some money, he's got the machines, but he still needs to get a truck, and he still needs to get some kind of interaction with the market. And he goes to a bank and they ask him, what is your turnover? And he says, look, I don't have a truck my turnover in this point is completely different from the turnover that I will get when you give me this money. But they say, look, I'm sorry, we don't do this kind of business here, we look for turnover. So the turnover will never get there. It's the same thing as saying, there's a job advert, and if you don't have 10 years experience, you can't get it. So how am I going to get the experience? These are the challenges we have. So these are big words, need to be big, braver, and dominant, but we also need to take the risks. Define them, identify them, and see how we can bridge that gap. Maybe this guarantee company would help us go there. There are some very strategic things that are happening in the economy today that we need to grab, and get all the players to put their hands around so that we can get to where we want to go. Thank you.
A round of applause for Mr. Lungeri, CEO at NESD OTC. Just a minute introduction. Yes, please. Can you kindly give him the microphone? Thank you, sir. You have the floor.
Okay, that's thank you very much, Proshare.
You work in a bank, sir, or you own a bank?
Thank you very much. I was just discussing with Tesla, so you guys are trying to rebase the banking industry. It's a nice one, bigger, braver, and dominant. One of the things I actually want to highlight, arising from both the presentation and the panelists, listening to Tesla, it sounds more like in the area of the fintechs, we're going to have is there a shakeout or an inflection very soon? Mm-hmm. Now, also look at the whole issue of enabling development. You see the level of techs have done. If you look at customer experience, innovation, that includes fundamental issues in terms of driving economic development. Given this kind of contradiction, where does it lead us to? Because we are saying that the banks are going bigger by every day, but they are not enabling development. This same development conversation that has been going on since 40s, at a point we got tired of development plans. I don't even know what we are talking about now. But where lies the solution? Because we are seeing the small and nimble trying to make impact in terms of making life easier. And then we also see big ones getting bigger, but we are saying there's no handshake with development. Thank you.
Thank you so much. You're very short and straight to the point. Let me take the gentleman at the back. On the red chair, thank you. You have just 1 minute, sir. Can
Yeah,
you kindly
thank
introduce
you.
yourself?
My name is Dr. Derek Omole, SME Secretariat. I think I'm quite impressed with the way the man who talked about, the 30,000 feet difference, to SMEs. And when, you made example of the banks in South Africa, having so much funds, but are not able to solve problem, I think the researchers here, maybe Proshare, are beginning to think deeply to know that there's problem there. So it means that even if you have banks that have all these kind of funds, it may also replicate itself in the situation in Nigeria. And that's where the question of economic development comes in. What does that mean? It means that economic development requires much more than just having big funds that will become idle. It means that the banks need to begin to re-understand the process of economic development. I was just telling somebody around me, he's saying that, we really do not have a thorough economic coordinator in Nigeria. And the reason is because if you find out that there can be funds, what you need to do is look at some key basic sectors, find a way to invest in them to build your value chain, production sectors, mineral sectors, and before you know it, you'll be creating better economic development.
All right, thank you so much. I think this report is part one. I'm sure by March 31st next year, Proshare will have another report, which is an update. Getting bigger, braver, and dominant. What's next? All those in favor say aye. No, Taslim, I'm waiting for you to say hi. It's more, yes, yes, just a quick one to frame you there, because again, we're going to have everyone recapitalize. So what's next?
Okay, so, well, since I have access to everyone, I could almost ask, but since we're on TV, so let me ask now. So that people can capture my concerns. This is the only opportunity I will have to speak without being fearful of being picked up. Okay, so let's break the whole thing down to simple tax. I love what Longe said. I'm not sure the gentleman understood the point about South Africa you made, but there's always an interesting thing why I pay attention to South Africa, because I'm always very interested in capital formation. See, instructively, yourself, Boason and myself and Dr. Adedipe, you know this, that how did Nigerian banks emerge that they are bigger than insurance companies and pension companies? That's an aberration to start with. The real process is that savings, pensions, insurance should be the driver of the economy.
Now you're talking to Discovery in South Africa, now opening a bank. First being an insurance company.
Insurance.
They're now getting a banking license.
If you do not understand that about the Nigerian financial services system, linking it to development is also wrong. Because if you understand, Madam Dave will tell you that for those who have worked in the CBN, if you understand how these banks emerge and the backdoor channel that had to keep them to operate, they basically were not even customer focused. At the beginning, they were transaction, big ticket deals, government, whatever it is. And so by understanding the evolution, therefore, we are saying that we have learned how to do better storytelling. What we then mean by bigger, braver, and dominant means that we would then have to pick who we compare you with. But you see, grow your banking sector without ever addressing the fact that your savings is not moving anywhere. And so to the question which he asked, that we don't have a knowledge of how SME works, it is so true. Give you an example. You are unknown to your bank. Because if you are known, your transaction history tells you everything they need to know about you for over 10 years. But technically, you are unknown to them.
Even with KYC?
No, those are just documents. So summary of it all is this. So two things can be right at the same time. We can acknowledge all those facts, but we can also acknowledge the reason that if you're not recapitalizing, basically with devaluation, your your banks are basically nowhere. So we have to address that. We are even saying that that's going to be enough. And what I picked up correctly, what Madam said and the panel said, and they did what he said, is that we will take it on board for ourselves to understand that it may be necessary to help identify that linkage between the gaps and create the bridge. Thank you very much.
Thank you so much, Efema, for that robust. Let's take my colleague. We have a hand on the third row. I think that will be most likely the last intervention.
Okay.
Thank you so much.
My name is Mele Ono. I arrived from Bloomberg. I was talking with a bank CEO the other day. So he told me that some of them, when they go outside the country, they treat them like FDI. That is, they roll out the red carpets and welcome them very well as foreign investors, just like Tinubu will welcome an American investor. So he was telling me that they are looking at opportunities outside Nigeria. As a matter of fact, they want to consolidate their operations outside Nigeria. So they want to use the capital they are raising to mitigate their risks. And if you look at it objectively, quite a lot of them are growing offshore, that is outside the country, more than they are growing in Nigeria. And I know that substantial portion of this fund will go to open new branches, maybe US, in Asia countries, and all that. And I want to ask, looking at it objectively, doesn't it make more sense for them to do that? Because if you even look at our currencies, a lot of them have made very good, stable income outside some African countries than even in Nigeria. So looking at it objectively, is it not better for them to deploy it outside than retaining it here? That is not removing sentiment. Then another thing, is there a way central bank can regulate to not say, okay, you raise this money here, so a portion should be retained to develop Nigerian economy? Is that the way a central bank can go? Thank you.
All right, thank you so much, Emiliano. Thank you for those points. Let me get a microphone back. Okay, I guess we have one more, just one more. I'll defer on gender. Thank you so much, madam.
Apologies, we came in late, but I just want to add one or two things.
What's the name, ma'am?
Bumi Oladosu Wema Bank.
All right, thank you, ma'am.
Yes. There are some fundamental issues that most times we don't consider, especially, let me just say Nigeria, let me not talk about other African countries. The recapitalization of banks, is it good or bad? It's good. But can banks operate in isolation? No. If we look at recapitalization 2004, 2010, we're in 2005, what impacts can we say this had on the financial institution? After the first recapitalization, we had issues with the banking sector. It was resolved. There were mergers and acquisitions. We had issues. Now we are here. We say we need recapitalization. Almost all the banks have concluded recapitalization. And all of them are making up the money. Are we going to see what we want to see? The issue is that, is there a link between the financial institution, the regulator, the government, and the people? There's no link. And until we have the link, we might not get the result we want to get. The SME, we are talking about SME. When you look at the behavior of SME, how many of them encourage the bank to invest money there? That's number one. Number two, when you look at government, the responsibility of the government to make the environment suitable for SME to grow, so that when you go to bank and bank release money to you, you can do business and you can return money. Have we taken care of it? The regulators dealing with the banks, some of these sledgehammer, you do this, have they taken time to work with the banks and understand the pain point of the bank and try to do some things that make operation easy instead of forcing them to cut corners. Have they done that? Now all of us were going to raise the money. Yet they are looking outside Nigeria. Why? Because they feel that if I go outside, the regulation in that place might not allow the people that will get the fund from them to misuse. So that's why they are going there. So the issue now is that recapitalization is going to close by March 2026. Is the regulator prepared? Is the government prepared? The SME, they have association, they have everything. Are they prepared? You and I, that we are assessing the situation, are we prepared? The reporting entity, the valuation people, the rating agencies, are they prepared? So the issue is that we will raise the money, we will get bigger, we will get braver, banks will be flying, but will the industries be flying? Will the regulators be in charge? Will the government have fulfilled its own? FRS also is part of it. Thank you very much.
Thank you very much, madam. We appreciate those points, those are valid points. Let me allow my panelists to have, and I'm going to be a little bit generous, 2 minutes closing thoughts. Let me start with Dr. Adigun here of a CIBN.
So let me once again thank Proshare for this opportunity. In Nigeria, we have a lot of solutions to our problems. Today, we have come up with a whole lot. And I hope and trust that what we have come up today will be passed on to appropriate quarters and they will implement it. If government implement 10% of what we said here today, Nigeria will be a better place to live. Thank you very much.
All right, thank you so much. Well, thank you, Dr. Adigun of CIBN. Dr. Akanji, please. Dame Akanji. Yeah, please speak.
It's working now. Thank you, moderator. I think there are a lot of institutional issues that have been raised on the floor, but I really want to commend the effort of Proshare, because in their presentation, they showed these problems in the micro and the macro dimension. If they can go to their presentation or their bigger, braver, and dominant report they have, I think we will begin to see solution, because I listened succinctly, I listened very carefully to their presentation. It was data-driven, and I think they can help the economy and help the bank in this dimension. They broke down the micro issue and the macro issue. I also want to say that the fiscal dimension of our problem had not been addressed. Because if you are looking at monetary alone and ignoring the fiscal dimension, we are not going to make any move whatsoever. The fiscal dimension speaks more to SME than the monetary dimension. So I just want to say that. Thank you.
Thank you, Dr. Akanji. We appreciate that so much.
All right. But now my closing thoughts is to underscore the fact that we should move away from pointing to government all the time. Because oftentimes, each time we dimension problems in our economy, we point in the way of government. We forget that there are different actors in an economy, and every actor has its own responsibility. So now we've gone through this cycle of recapitalization over and over again in Nigeria. For those of us who have followed the industry for close to 40 years thereabout, we've seen this over and over again. From the days of capital of 10 naira, 5 million naira for a banking license to where we are today. Okay? Same story. But the point is, within my own scope of influence, what can I do? And I think there's a missing link. Dr. Adigun mentioned implementation of recommendations emanating from this Proshare report. But I will add one thing and then shut my mouth today, and that is consequence management. Consequence management. we do a lot of things that amount to errant behavior. But because there is no sanction, people get entrenched in repeating that over and over again. And that is why we are not moving beyond what my friend over there said. Development plans. First one, 1962 to 68. We've done many since then, but because we don't implement religiously, and then where people fall out of track, no consequence. If we begin to look, then the connection that we made reference to, the SMEs, the government, the central bank, the banks, everyone will play its own role. And when you fall out of track, you also get a slap on the wrist. So clearly, we'll all begin to drive in the same direction. Thank you very much.
Thank you, Dr. Adedipe. A round of applause to you. Thank you so much. I appreciate that.
Okay, just to add to the insightful suggestions that have been made is technology. So for the banks now, with artificial intelligence, they need to see how they want to embed that into the financial system. We spoke about the ability to study the behavior of their customers. And with that, it will make it easier to channel credit. Even for the SMEs, and that's what makes difference between some of the fintechs, that they're already using that to know where to channel funds to the SMEs. So I think adding technology to businesses beyond using it to process or for the operations, you need to use that to determine what products do you come up with and how can you be more effective in channeling credits that would eventually grow the economy and make it bigger. Thank you.
Thank you. Please give a round of applause to my panelists, Dr. Ayodeji Ebo of Optimus by Afrinvest. Thank you very much. Dr. Adedipe from B. Adedipe, an Associate CEO and the Chief Consultant. Dr. Akanji, thank you very much, Dame. We appreciate you here, former Director of Trade and Exchange at the Central Bank of Nigeria. And of course, Dr. Adigun representing our chief host, Professor Larewaju, President and Chairman of Council of CIBN. Thank you very much. Please give a warm regards to Professor Larewaju for allowing us to use this hall for Proshare for this event. As always, we say a very big thank you. Please, another round of applause for my panelists, and a big round of applause to all of you for being here. Thank you so much, Taslim Tosige, for those insightful review of the reports and the macroeconomic environment, the entire Proshare team. Thank you very much for all your time that you put together to do this research. I know research work is not easy. It's a heavy lifting. It takes time. It consumes data, a lot of brain work, checking sources and verifying data. It's not easy. That's why not many people do it. So when we find those who do it in this environment, we appreciate it so much because it enlightens what the government and the private sector do. And that is why we're happy to have a number of you from the private sector here. We thank you very much from Access Bank, from NESD, and elsewhere. Thank you very much for coming. Our colleagues in the media, thank you very much too for your time. And I want to say a very big thank you to those who are online who have been watching this class of 2025. We are the graduates of the 2025. Please give us another round of applause. Thank you. Bigger, bolder, and dominant. My question, what's next? Thank you, everyone. Have a great day.
So we're taking some pictures right now. Mr. Olufemi Awoyemi, could you please join the panelists on the podium? Mr. Olufemi, sir. Yes, sir. Mr. Teslim and Tosi Ige. Please join them on the podium. Yes. Mrs. Bumi, please join. Mr. Longe, sir. Mr. Longe, Mr. Victor, please join. Okay, all right, thank you.